Hour of 10:15 have arrived. We'll call the House Tax Committee to order. We do have a quorum. Today's agenda is I'd like to go around the table, have everyone introduce themselves and what your district is, just a little bit about you, if you will. But before I do that, I'd like to introduce our staff here first, or have the staff introduce themselves. Let's start over here with Partisan Research.
Yeah, hello, I'm Jacob Cowan. I'm the partisan researcher for the GOP.
Okay. Sam?
Sam Moyer, the tax CA.
I don't think they're working.
Jennifer Goblish, Committee Legislative Assistant.
Okay, then we'll start down with Representative Harder if we could.
Representative Harder, Bobby Harder. I represent House District 17B, which is the majority of Sibley County, and then parts of Carver and McLeod, and I am happy to be on this committee. Thank you.
Representative?
Hi, Representative Kristen Robbins. I represent District 37A, which is Western Maple Grove, and all of the communities of Corcoran, Medina, Greenfield, Independence, Loretto, and Maple Plain. I love Tax Committee. It's the most fun committee.
Representative?
Representative Cal Warwis, Iron Range, District 7B, formerly Dave Lislegard. I represent the cities of Virginia, Chisholm, Mountain Iron, Evelyn, Gilbert, Belwabic, Aurora. Probably heard of a lot of those. I'm a second-generation steelworker, and I'm really happy to be here.
Zazinski?
Hi, Chris Wazinski. I represent House District 15A down in southwest Minnesota. I have the counties of Lyon, a little bit of Chippewa, Yellow Medicine, and Lac qui Parle. And yeah, thanks for having us on the committee. Look forward to doing some great work this session. So,
Thank you. Representative Johnson?
Wayne Johnson, District 41A, first time elected. Excited to be on Tax Committee just because I've seen what taxes have done to businesses. I'm a small business owner and the community, including the counties and property taxes, being a county commissioner, former county commissioner. My area is Cottage Grove, Lake Elmo, the river communities, Grant, and along that way. Thank you.
Representative Roach?
Yep, Drew Roach. I cover District 58B. I'm excited to be here, and you know, as Wayne has stated, I'm a small business owner myself, so definitely have an interest in the tax committee, and I'm happy to be here.
We're glad you're here. Representative Whitty?
Thank you, Chair. Jeff Whitty, I represent 57B, which is northern Lakeville. This is my second term on taxes, so thanks for having me, and I also serve on public safety.
Thank you. Representative Schwartz?
Hello, my name is Erica Schwartz. I represent Nicollet County, which is 18A, which covers North Mankato, St. Peter, and Nicollet. I am a small business owner. Me and my husband own a gas station, so I'm excited to be on the tax committee.
What's that really good meat locker in Nicollet?
Yeah, the Schmitz Meat Market. I worked there for 7 years. Yeah,
Good place.
yeah.
Good place.
I'll have to bring some up.
Representative Joy?
Representative Jim Joy. I serve District 4B, which is Clay County, Becker County. This is my second term being on taxes. I love this committee. This is probably the best committee, and look forward to reducing taxes to help everybody's life.
Is there anything you'd like, Representative Joy?
Anything I would like?
I mean, after that introduction. Representative Anderson, we're just introducing ourselves here.
Okay.
good timing.
Am I up?
You're up.
All right. Representative Patty Anderson, 33A, Washington County. So, second year on the tax. Second.
And I'm Greg Davids, District 26B, and I don't know if I'll be here that long because apparently Iowa is buying the lower row of counties, so I always wanted to own some Iowa farmland, so that's, I guess that's one way to do it. So, no, that's not gonna happen, so. People actually took that seriously. Oh, I had people calling me up just going wild. I'm going, Uncle Greg will take care of it. Don't worry about it.
Say Gophers, not Huskers, or
Hawkeyes.
yeah.
Hawkeyes. Okay, so with that, welcome. This is a great committee. We've got great members here. I'm hoping that some more great members will show up shortly. We are organized. The House is organized. This committee, as I said, we have a quorum, so the Ms. Goblish will take the roll. Not take the roll, you've already taken it, sir. Okay. So let's start out with House Research from Fiscal Overviews. We want to hear their presentation, what each one of them is responsible for, what area they're looking at. And would you like to go in your order or my order? My order says Chris Clayman, Sean Williams, Justin, Alexandra, Jared, Cynthia, and Katrina. You want to do it different?
However they want to do it.
However you want to do it.
However they want to do it.
We'll do your order, you're in charge. I don't feel that way. No, it doesn't, if your presentation is, Mr. Williams, why don't you go first? Looks like you want to go first. And while you're coming to the table, Representative Wiener, we just kind of had an introduction, district numbers, if you could do that for us. Yeah.
Representative Mike Wiener, District 5A.
Thanks for being here. Okay, so let's go with, we've got Mr. Chris Clayman, Mr. Sean Williams. We'll just let you take it away.
Chair Davids and members, for the record, I'm Sean Williams from House Research. I staff the individual income tax area, so I think as we go, we'll probably introduce ourselves and sort of mention to the committee which areas we staff. Don't worry too much about keeping track of it, but it's just a way of introducing ourselves. So our presentation today is going to cover kind of a committee orientation, roles of nonpartisan staff, and committee important documents, some basic concepts about taxes, the major state taxes, the individual income taxes on business, sales and use taxes, and a very brief slide on property taxes, because we've been instructed to give a more full presentation on property taxes tomorrow. Evaluative criteria for considering tax proposals, and then so my colleague, Mr. Clayman, and I are from House Research. Our role in the committee is to draft bills and amendments for the committee, write bill summaries, so descriptions of what the bills do, provide background research and overviews, answer questions about bill content and potential legal questions relating to bills. And then our office also does modeling of tax proposals, so we can sort of estimate distributional effects, sometimes do back-of-the-envelope calculations on fiscal effects, those sorts of things. I'll let our colleagues from House Fiscal sort of describe in more detail their role, but they mostly track the revenue effects and budgetary effects of proposals before the committee. So some of the important documents that you'll see in your packets every week are bill summaries. So there will be a partisan bill summary prepared by our partisan researcher, but also nonpartisan bill summary prepared by House Research. There will typically be revenue estimates and potentially fiscal notes for proposals being considered by the committee. There may be spreadsheets describing the fiscal effects of bills. As I mentioned, there may be partisan briefs by the committee, the partisan researchers, and then letters from testifiers and other information about bills and other things in front of the committee. I'm going to proceed to talking about some basic concepts in taxation. These are sort of background information for how to think about taxes. So every tax that the state has a base. The base of the tax is the income, the property consumption, or the other activity that is subject to the tax. A tax base can be broad if it covers a big proportion of the total activity, or narrow if it covers a small portion of the total activity. Tax rates, so every tax also has a rate. The rate is the percentage of the base which has to be paid in taxes. Some taxes have a flat or per unit rate. Many taxes have rates set as a percentage of the base, and some taxes have graduated rates. So when you calculate the liability for a tax, typically the multiplication is the base times the rate. That equals the liability for tax. It's a little bit more complicated if they're a graduated rates. The base may be reduced by deductions, exclusions, exemptions, and subtractions, and the product of multiplying the base times the rate may be reduced by tax credits. So essentially, liability for tax can be reduced by credits. The tax revenues for a tax equals the sum of all liability for tax minus the tax gap. That's the amount of tax that actually goes unpaid. The total revenue from all state and local taxes equals the sum of all taxpayers' liabilities minus any tax gap. So before the committee, you may have proposals to modify tax revenues. Tax provision could raise revenue by broadening the base, increasing the rate, limiting deductions or credits, repealing deductions or credits, increasing tax enforcement, or enacting a new tax. A provision could reduce revenue by narrowing a tax base, decreasing a rate, expanding a deduction, enacting a new deduction, decreasing tax enforcement, or repealing tax. Another thing that this committee deals with quite often is spending in tax laws. So in many budget years, the tax committee may have a budget and may choose to spend that budget on different proposals or bills. Tax expenditures are structured differently from expenditures of finance of appropriation committees. They typically take the form of standing appropriations for credits or for refunds, open appropriations of unspecified dollar amounts, dedication of specific tax revenues for specific purposes, or tax expenditures. Tax expenditures are special provisions of the tax code that reduce taxpayers' liability for tax. They can be deductions, credits, preferential rates, and brackets. They provide financial assistance for specific activities, entities, or groups of people. Tax expenditures are considered analogous to direct spending programs because, like direct spending programs, they impact the state budget, pursue some of the same purposes as direct spending programs, and impact the economies in many of the same ways as direct spending programs by influencing how people work, spend, and invest. I'm not going to read all of these aloud, but this is sort of just for your information. It's a list of different sort of policy areas and other committees, and you can see that there are sort of, within the tax world, policy proposal or existing laws that affect different policy areas in other areas. So there's agricultural, capital investment, education, energy, natural resources, housing, and veterans and military affairs. And there's sort of tax expenditures covering all of those different areas. Next, we're going to proceed to talk about some of the major taxes in Minnesota. I'd mentioned that people say that the three largest taxes in Minnesota for the purpose of state and local taxes are income, sales, and property. Our presentation today is focused on state taxes, so we're going to do a very brief discussion of property taxes, even though that's also considered a major tax. So the income tax is the largest state tax. It's about, in fiscal '24, is about 44% of total state tax collections. Sales and use is the next largest one at 25%, and the corporate income tax is about 9%. So those are the three largest taxes in terms of state revenues. Our fiscal colleagues will go into more detail about sort of the relative sizes of these and how much revenue is collected. The individual income tax is paid to the state in three ways: through Minnesota withholding tax, so that's when employers withhold state tax from employees' paychecks; quarterly payments of estimated tax, so those are required for income that's not subject to withholding. So you may have capital gains, you may have other investment income, and there's no withholding on that, but you're required to make quarterly payments of estimated tax. And then there's final payment of tax or potentially a refund at the time when you file your return. Income tax revenues are deposited into the state general fund. Use of the general fund dollars is determined by appropriations of the legislature. We have no local income taxes in Minnesota. There's a general law that prohibits local governments from imposing them. The base for the individual income tax is called Minnesota taxable income. It starts with federal adjusted gross income, which is often abbreviated to FAGI or AGI. We have state additions, so things that are not included in federal taxable income but are subject to the state income tax. We have a dependent exemption for people that have dependents. People get to claim standard or itemized deductions. And then there's also state subtractions. Those are all deductions from federal adjusted gross income. So the sum of those different parts results in Minnesota taxable income. That's our tax base. For the purposes of calculating our tax base, Minnesota has a standard deduction. It's similar to the amount in federal law. It's $29,900 for married couples filing joint returns, $14,950 for single filers. The dependent exemption is $5,200 per dependent. These amounts are for tax year 2022. I mentioned earlier that we have additions. Many of these deal with nonconformity to federal provisions on things like depreciation losses. There are other things that are like bonds that are tax exempt under federal law from other states that we do require people to add back on their state return. Excuse me. Minnesota also has a number of subtractions. Some of these deal with constitutional limits on taxation, like earnings on Indian reservations, federal exempt interest, those sorts of things. And then we also have some policy choices that were enacted through subtractions. So we have a subtraction for some Social Security income that's taxable federally, organ donation expenses, 529 contributions. So we have a number of other state subtractions. As I mentioned, our tax base is tied to federal law. Our tax calculation starts with adjusted gross income. So you can see that the green calculations in the bottom right of this slide are the Minnesota calculation of liability, and the blue ones cover the federal calculation of liability. So you can see our tax diverges from the federal tax at adjusted gross income, meaning the things in the bottom left of the slide here do not affect our state tax. Mr. Clayman, would you mind covering the next slide while I take a sip of water?
Mr. Clayman.
Mr. Chair and members, I'm Chris Clayman, also from the House Research Department, and I staff the areas of, also in the income tax area, but I cover corporate franchise taxes, which we'll get into what those are in a few slides. And generally speaking, I also cover all the business taxes, although Mr. Williams and I will share duties on tax credits that are allowed for both individuals and corporations. I also cover the estate tax and liquor taxation as well.
Chair Davids, hopefully my voice is recovered. I'm sorry, I'm getting over a little bit of a cold.
Mr. Williams.
So, as I mentioned, our tax base is tied to federal law. That means that federal laws and rules that affect adjusted gross income also affect Minnesota liability. I would note that most of the rules for calculating business income, like depreciation, net operating losses, and things like that, affect FAGI. Changes in federal rules aren't automatically adopted for Minnesota's purposes. We're what's called a static date conformity date state, which means that the version of federal law that we use for calculating our tax is set in state law, and we don't take on federal changes into the state income tax code until the legislature votes to adopt that. So our state law says we have adopted the Internal Revenue Code as amended through May 1st, 2023. There have not been significant federal tax changes since then, so we are mostly in conformity with federal law. However, as you're probably aware, many federal provisions of the 2017 Tax Cuts and Jobs Act are expiring. So Congress may, during this legislative session, extend some of those provisions, and we would need to respond to that.
You choked up about that.
Mr. Chair and
Mr. Clayman.
and members, going to jump in here for Mr. Williams. And if I have to tag team something, I'll just phone a friend here and Mr. Williams can help. The next slide shows the income tax rates in brackets for tax year 2025. You can feel free to take a look at those. But I think probably the broader point to make on this is that the state sets their own income tax brackets and rates. And there's 4 tiers with the rates going from 5.35% to 9.85% under the individual income tax. So as Mr. Williams explained, after your tax is calculated and you've taken all of your state additions and subtractions, which, and after you've started with federal adjusted gross income, which can include other business income deductions, then you're allowed to take certain credits against the individual income tax liability. Those reduce your tax on a dollar for dollar basis. And so they're more valuable as a result, and that's the third bullet point. So your deduction is typically worth the amount of the deduction that you're allowed to take multiplied by your marginal rate. And so that's always going to be a percentage of the total amount, whereas a credit allows you to take a dollar for dollar. So the amount of the credit, you take dollar for dollar, so you get 100% of the amount. So typically credits are a lot more valuable. There's a couple other concepts on the last 2 bullet points. The state has refundable and non-refundable credits. So non-refundable credits only reduce your tax liability to 0, but a refundable credit can actually go below 0, and then you'll get a tax refund for essentially an overpayment of tax because that refundable credit has allowed you to go below 0. The next slide is about tax expenditures. I think a fairly, I guess, general definition of a tax expenditure is it's where provision in the state or federal tax code that the state conforms to essentially is characterized as the legislature enacting a spending provision through the tax code, even if that's characterized as a as a tax or a tax provision. And so you can see some examples of tax expenditures here on this slide under the individual income tax. I won't list them out, but, and I think it's worth mentioning too that the legislature established a tax expenditure review commission to periodically look at tax expenditures and review them. And so you may hear something about that in this session of the legislature. So, Mr. Chair, members, that actually concludes the slides under the individual income tax that Mr. Williams prepared, and I'm happy to move on to business and corporate taxes.
You know, let's stop right there a second. I should have made the announcement beforehand that I understand that it's okay if members ask questions during the presentation. So before they move on, are there any questions at this point? Representative Johnson.
Thank you, Mr. Chair. I'm just going back to see if there's a reason or if something got left off, but the last slide you had regarding individual income tax expenditures, marriage penalty was written down as twice. Is there something else that was supposed to have been there, or is it just written down twice?
Mr. Williams?
Chair Davids and Representative Johnson, I think that's just a mistake, and it was listed twice, so my apologies for that.
Because it's a double impact on you, so.
I was gonna bring that up.
Freudian slip.
Okay. Representative Harder.
Thank you, Chair Davids. My question is in regards to the marriage penalty credit. Can you explain a little bit more why there's penalty and a credit? Need more explanation, please. Thank you.
Mr. Williams?
Chair Davids and Representative Harder, so our bracket structure and other provisions of our tax code introduce a marriage penalty. So because the phase-outs on a tax credit are not double for a married couple what they are for a single filer, that would be a marriage penalty. And likewise, our bracket structure, the married joint brackets are not double what they are for single filers. So the marriage penalty credit is designed to eliminate the marriage penalty from brackets only. So if you look at the bracket slide here, you'll see that the married joint brackets are not twice those of single filers. What you do with the marriage penalty credit is you calculate essentially what the tax would have been if you filed as two single filers, and then you calculate what the tax is filing as a married joint filer. And then the difference between that is given to you as a credit to sort of eliminate the marriage penalty from the brackets specifically.
Representative Harder.
That's all. Thank you.
Representative Robbins.
Thank you. Hate to tax your voice, Mr. Williams. Regarding that, I've been doing some work on working to eliminate the marriage penalty in our tax code, but I've been trying to figure out, where we stand relative to other states. Do you have any data on how we line up with the significance of our marriage penalty here versus either nationally or just our neighboring states?
Mr. Williams.
Chair Davids and Representative Robbins, I don't have anything on that offhand. The biggest marriage penalty in our tax code was from the bracket structure. So that credit we established does sort of address that. But I don't have any data comparing us with other states. I can see if I can find something on that for you.
Thank you.
Representative Robbins. Any other questions before we move on? Okay, Mr. Clayman or Mr. Williams? Mr. Clayman.
Thank you, Mr. Chair and members. I already introduced myself before, so I think I'll skip that. So moving on to the slides on state income tax on business. Typically, when we do this presentation, we usually go from the individual income tax and we move into the corporate franchise tax. So most of the next 5 slides will relate to the corporate franchise tax. But I thought it would be a good idea just to reinforce the idea that in Minnesota and other states, there are really 2 separate taxes that apply to individual, or that apply to businesses. And the manner in which a business pays state income tax on its business income has to do with the manner in which that business is organized. So if the business is incorporated as a C corporation, these are typically the large publicly traded corporations, the big interstate or multinational corporations. Those will pay the corporate franchise tax, and it's actually a separate tax in the tax chapter of law. Whereas if you're a pass-through business or you're a sole proprietorship, so pass-through business meaning you're a S corporation that's elected to be taxed as a pass-through business, or an LLC or a partnership, you'll actually be taxed under the individual income tax. And so there are some differences under those taxes in terms of how those businesses are taxed. So I thought instead of just doing a set of slides on the corporate franchise tax, we would just do them this year on state income taxes on businesses. One of the main differences is that C corporations, under the corporate franchise tax, those corporations are taxed at the entity level. So the business itself pays a tax as an entity, both federally and at the state level. Federally, a corporation will file, instead of a 1040, they'll file usually in a Form 1120 is what the name of that federal form is. And the starting point, that then determines that corporation's federal taxable income before certain deductions. And then it's federal taxable income from that Form 1120 that becomes the starting point for the payment of Minnesota tax. So Mr. Williams had that slide on, or described that slide on federal conformity. So under the individual income tax, the starting point for tax is federal adjusted gross income. And then the state has their own deductions for those individuals, whereas for corporations, it's federal taxable income. And one of the reasons is that C corporations don't get all the personal deductions that an individual gets. So you can start with federal taxable income for them. Another item to point out with corporate taxation is that while a corporation is taxed at the entity level, if that corporation returns some of its profits in the form of a dividend to a shareholder, if that shareholder is also a taxable entity, so it's not a nonprofit or something, then that dividend will also be taxed as income to the recipient shareholder. So there are commonly concerns that are raised under corporate income taxes in the United States regarding double taxation of dividends, or double taxation because the dividends are also taxed. It's why federally and at the state level there are dividend received deductions that intend to mitigate some of the effect of that double taxation.
Representative Anderson?
Thank you. Can you talk a little bit about after the SALT deduction was changed 8 years ago, with the Trump, was it been 8 years? Maybe 6 years? How that changed for S Corp and LLCs that can essentially paying the state tax to the partnership, and how that affects the individuals, not just within, but how it would then affect their individual income taxes.
Mr. Clayman?
Sure. Mr. Chair and Representative Anderson, yes, so that's, I think I have something on I think I have a slide. I think this is the slide I was going to talk about that, just verbally, but I can answer it now. In 2017, under the Tax Cut and Jobs Act, there was Congress imposed what's called a SALT cap deduction. So SALT just is an acronym that stands for state and local taxes. And businesses are able to take a deduction for state and local taxes on their federal tax form. But after the limitation passed in 2017, there was a limitation that was passed that limited the amount of the state and local tax deduction under the individual income tax federally to $10,000 for married filers. What this meant is that if you were a pass-through entity and you were paying state income taxes on your pass-through income, because those pass-throughs are not taxed under the corporate franchise tax as an entity, so because they're taxed under the individual income tax, the ability of those pass-through businesses to deduct their taxes was limited also by that $10,000 SALT cap that Congress enacted. And so that's because of those differences between how how corporate franchise taxes work, where the tax is paid at the entity level versus how pass-through businesses are taxed. So in response, a number of states, including Minnesota, enacted what are called pass-through entity taxes. These are typically revenue neutral, as is Minnesota's tax. And what that does is it allows, under rules established by the Treasury Department, it allows pass-through business to essentially pay a tax at the entity level at a state, and then they're able then to deduct the full amount of their state and local taxes federally. And so that was a response to the Tax Cut and Jobs Act and the SALT cap limitation. And so if that, I assume that's what you're asking, Representative Anderson.
Representative Anderson? Yep. Mr. Clayman, what year, I think I carried that bill with a lot of support from the other side of the aisle, if I remember correctly. What year did that go into effect?
Mr. Chair, I believe that was either 2019 or 2021. I think it was 2021 is when that went into effect, yes. I'm getting the nod from some of my colleagues over there. So.
That was a good thing. That was a good thing to enact that because we were really getting hammered. A lot of people were, not we, but a lot of people were. So, okay, Mr. Clayton.
Sure. So moving on to slide 2. So pass-through businesses, as opposed to corporations, they're typically smaller, although they don't have to be. C corporations, if you own like a share of stock in a publicly traded corporation, you could have, millions of shareholders. Those shareholders are the owners of the business. For a pass-through business, you typically have a fewer number of owners. So depending on the type of pass-through business, you could have, a member of an LLC or a partner in a partnership or a shareholder of an S corporation. So those are typically smaller businesses. And most of the time, they're going to pay tax on their business income under the individual income tax, not at the entity level. And that can, well, I'll move on to bullet 2. So because they're not being taxed at the entity level, the income of the partnership, so the entity as a whole, is passed through to each member individually or each partner individually. And as are items of like deductions and state subtractions and additions. And then for tax credits that businesses are allowed to pay, each members typically receive some sort of a pro rata share of that credit because they have to take all those deductions and credits and they have to apply them on their individual income tax return. And then also, so the profits of those pass-through entities, unlike the dividend issue described on the previous slide for C corporations, those profits are only taxed once under the individual income tax. There are some other differences between pass-through taxation under the individual income tax and the corporate franchise tax, and one of those is the rate. So the corporate franchise tax has one standard rate of 9.8%, whereas under the individual income tax, a business owner may pay on any one of the 4 tiers. So there can be rate differences as well. And then also for pass-throughs, so you've got your business income. If you're a business, you take your pro rata share of that income. And then on your 1040 and your Minnesota taxes, any other item of income for that business owner as an individual will also be included in the income of that individual. So if you have a wage income or a capital gain or something, that will also be included, kind of all lumped together on your 1040. So then moving on to slide 3. Again, Mr. Williams explained that the state conforms to the federal tax code as a starting point for Minnesota tax. So this applies to all the business deductions under the federal Internal Revenue Code. So for instance, the business expense deduction under section 162. So Minnesota conforms to all those. And those apply equally under for pass-throughs and for C corporations. So businesses all receive the same deductions even though they have different tax bases. There are some exceptions though to conformity. Minnesota has their own state additions and subtractions. Subtractions is just what we call deductions in Minnesota. One example, this is bonus depreciation. That's a federal deduction that's allowed for depreciation of capital equipment. Federally, taxpayers are allowed to take that deduction in the year that that property is placed in service, whereas in Minnesota, there's ultimately a 6-year time period for taking the amount of that deduction. So that's an example of nonconformity on a business deduction at the state level. And then I'd just reiterate that business tax credits are allowed. For instance, the film credit or the housing credit or the research and development credit. Those are allowed for businesses in the state, and they're allowed for both pass-through businesses and C corporations.
Representative Whitty.
Thank you, Chair David. Are there any conformities that we have to line up with the federal government like we had to do the first time? And is there any future ones that we should be aware of?
Mr. Clayman.
As far as, they're right now in the, well, I guess to answer your first question, there are a couple nonconformity items, if this is what you're getting at, Representative, under the Minnesota corporate franchise tax and individual income taxes that are essentially just provisions the legislature enacted previously, like percentage depletion is another one for certain extractive industries. That's an area where the state doesn't line up. Right now, the last conformity bill that the legislature enacted was last year, 2 years ago. Yeah, 2 years ago. Actually, we had two conformity bills, and the state had two conformity bills in 2023. Right now, there haven't been any other federal tax changes that would require the legislature to decide, whether they wanted to conform to those or not, although there's talk about, Congress enacting a tax bill soon. And then depending on what's in that federal tax bill, then potentially that could come before the committee for its deliberation.
Thank you. Because most of the time that is a big benefit towards our businesses to get everything aligned, correct?
Representative Davids, or Mr. Chair and Representative Woody, you can if the state doesn't conform to certain deductions, there can be that can cause some administrative complexity for taxpayers, especially in those areas where you have ongoing, multiple year effects. So net operating losses would be one example of that, or depreciation would be another one. And it can get pretty, those complexities can increase when there are multiple elements of, say, Section 179 conformity, which is a depreciation benefit allowed federally. There are a number of changes that Congress made, for instance, in 2017 regarding the thresholds for taking the Section 179 deduction, amounts that qualified. And so when you couple that with a difference not only in the amounts that might qualify for a deduction, but also in the timing of when you can take that deduction, so those complexities can mount up.
Thank you.
Mr. Clayman, you kind of caught me off guard here a little bit on the conformity with extractions. So would that be mining? Would that be sand and gravel? Would that be, and how long have we not conformed, and what would it take to conform?
And, Mr. Chair, so I believe you're talking about the percentage depletion.
Yes.
Well, so percentage depletion, I don't believe that would cover the aggregate tax on gravel. That wouldn't affect the aggregate tax. I would have to go back and research that to see if the net income of like a gravel pit would be affected by percentage. I believe it's just oil, gas, and potentially minerals. And percentage depletion is just a federal benefit that's allowed for those extractive industries that the state doesn't conform to. It allows one feature of it is that it potentially allows an extractive industry to take a deduction for their depletion that potentially could exceed 100% of the value of that of the mine or the well or whatever that they're extracting.
We'll talk about that offline.
Okay.
Thanks. Okay, please proceed.
And Mr. Chair, I'll double check all this too. If I've made an error, I'll just correct the record at some other time. So the slide 4 relates to, on business taxes, relates to apportionment. So this applies mostly to C corporations and the corporate franchise tax. The basic idea with apportionment is that if you've got a multi-state or a multinational corporation that's earning income presumably from multiple taxing jurisdictions around the country or around the world, the question then is, well, how much of that income can Minnesota, the state of Minnesota, subject to tax in Minnesota? So the way, and that's a constitutional requirement. And Minnesota, like many other states, just apportions income to Minnesota based on sales. And what happens is that under the apportionment laws, the state will look to the percentage of a corporation's sales that occur in Minnesota relative to the rest of its sales. So if 5% of a corporation's, total sales in the United States are in Minnesota, 5% of their income will be apportioned to Minnesota. And Minnesota also has something called single sales factor apportionment, which means we just use sales. We don't use anything else to make that determination. This can also apply to non-resident partnerships too, apportionment.
Representative Anderson?
Chair Davids, can you talk about how that's determined in the federal hands in that? Because there's at one point states were, fighting for higher shares.
Mr. Clayman?
Mr. Chair and Representative Anderson, I'm not familiar with I think the Hansen Act you said, or the.
Yeah.
Representative Anderson?
Mr. Chair, I don't recall the name of the act, but just, there's a federal regulation essentially, that doesn't allow a state to ask for more than it's, a divvy up. If a company is making, they do business in different states, in different countries, that is decided through federal statute. It's the same with investments and that sort of thing. Does that make sense?
Mr. Clayman?
Mr. Chair and Representative Anderson, I'm sorry, still don't recognize the reference, but I guess what I can say is that there are constitutional requirements that limit how much of a corporation's income can be taxed by the state. So that under the Constitution, under the Commerce Clause, a taxpayer has the right to divide the tax base, essentially, meaning to prevent multiple taxation. And so that's one of those, that's one limitation that states have to be aware of. And most of the states' apportionment rules reflect those constitutional limitations and potentially any other federal regulation that's required. So.
Thank you.
Representative Anderson?
Thank you. I know there was some discussion about that last session.
Yes.
Yes,
Yeah,
thank
there
you.
was.
Sure, yeah. And I'm happy to, Mr. Chair and Representative, to follow up later on more detailed information on that too, so. The last slide relates to what's called unitary taxation or combined reporting. This can come up in the Taxes Committee, and it has, sort of over the years. So unitary taxation is a method of taxing corporations that takes into account essentially what the modern corporate structure of most corporations are like. So typically a modern corporate structure might be composed of parents and subsidiary companies, and then maybe other, horizontally related companies, brother, sister type corporations. And often this group of corporations will fall under common ownership and control. And so what unitary taxation does is it treats the group of corporations as a single corporation for purposes of imposing the corporate franchise tax in some ways. One of the first things that happens under unitary taxation, so if you have a group of corporations that are that meet the rules for being part of a unitary group under state statute as interpreted by the Department of Revenue. All intercompany transactions among a group of unitary taxations are eliminated. So if you've got a purchase from a parent, if a parent company is purchasing something from a subsidiary and they're taking a business deduction for it and they're getting something for it in return, that business deduction would be eliminated. So they wouldn't be allowed to take that deduction. The other element of unitary taxation is then the entire amount of income of the corporate unitary group as a whole is subject to apportionment in Minnesota. And there's a tie-in here with apportionment as well, because under unitary taxation, which is based on sales, when that income is apportioned for unitary corporations, it's the entire amount of that unitary corporation's sales which are used to determine their overall sales. So apportionment is about the percentage of Minnesota sales. Under unitary taxation, you've got a corporation that's got, say 5% of their sales in Minnesota. Well, that percentage is going to go down once you include the total amount of those sales from every other member of the unitary group. So sometimes you'll hear references to the numerator or the denominator in the apportionment formula under unitary taxation. And so that's what that's talking about. And so while unitary taxation subjects a greater amount of income to apportionment in Minnesota, typically the apportionment percentage will go down because the denominator is inflated with every member of the group's sales as well. So there's a counterbalancing effect to that. The policy rationale typically behind unitary taxation is that it's intended to prevent transfers between companies from reducing tax liability.
Representative Robbins.
Thank you, Mr. Chair. How many states use the unitary method?
Mr. Clayman.
Mr. Chair and Representative Robbins, I don't have an exact count off the top of my head. And I don't want to guess, so I think I'll have to provide that information to you at another date. But it's a number of states. Certainly Minnesota is not the only state that has unitary taxation.
Representative Robbins. Okay. Mr. Clayman.
Mr. Chair and members, that concludes the 5 slides on business taxation in Minnesota.
Okay, thank you. Thank you very much. Any other questions? I was remiss in my duties as chair. We have 2 extremely important members in this, or people in this room that are going to become all of our new best friends. And that would be the Pages. If they could please introduce themselves.
Hi, my name is Joe Schatz. This is my 3rd year patient for the taxes.
Hi, I'm Sierra. It's my first year as a page.
Well, welcome. Welcome. Just remember, tax committee is not a committee, it's an adventure. Always remember that. Okay, sales and use tax. Thank you, Mr. Clayman. Thank you, Mr. Williams, for those presentations. Please introduce yourself for the record.
Mr. Chair and members, my name is Alex Hagler. I'm a member of House Research, and my portfolio includes sales and use tax, state and local, as well as some of the other smaller state taxes like cigarette, tobacco, cannabis, and gambling taxes. So for sales and use tax, the combined state sales tax rate is 6.85%, where 6.5 is the base sales tax rate and 0.375 is the rate imposed under the legacy amendment that was enacted in 2009. There's a typo on the slide. It actually is sunsetting in 2034. And the state constitution dedicates how the revenue attributable to the legacy amendment rate is divided between different legacy funds. The base of sales tax includes all goods, tangible personal property, and some intangibles like digital goods, unless specifically exempted by law. The base also includes some services that the legislature over time has enacted into law. But generally, most services are excluded from the tax base unless the legislature puts them in the base. The tax is collected at the retail level, so when you go and make a purchase at a store, the tax is collected at that time, and it's collected by the seller and remitted to the state, either annually, quarterly, or monthly, depending on that, the seller's annual receipts. For the most part, the revenue from the 6.5 portion of the tax is deposited into the general fund for general unspecified state uses. And the, as I said, the 0.375% portion is deposited into various legacy funds. The specifics regarding which funds can be found on pages 29 and 30 of this document that you have. This is a very long, detailed description of all of the state taxes that we've, that we're covering today. So anything that we haven't talked about might also be covered in this packet. There's also some detail about some of the more transportation-related sales tax items, and those are divided into transportation-related accounts. So as I said, the sales tax applies to all goods unless they're specifically exempted by statute. This slide details the many exemptions that sales tax has, and the common ones are listed here. For individuals, the biggest exemption is for food, clothing, and prescription drugs. Cigarettes are also exempt from sales tax, but there is an in lieu sales tax that applies. Businesses can have exemptions for certain capital equipment, farm machinery, and certain inputs. And sales to federal and local governments are also exempt from sales tax, as well as sales to many charitable organizations and nonprofits. Minnesota is a member state of the Streamlined Sales Tax Agreement, which has simplified and made uniform sales tax collection and administration for retailers and member states. Being a member of the agreement puts some restrictions on laws that can be enacted. As a very simple example, the agreement requires that there be one rate for all of the states, so the sales tax can't be like 6.5% for books and 8% for water bottles, things like that. Everything has to be kind of the same across the board. But as legislators, if it's your prerogative to pass laws. So if those laws put the state out of compliance with the agreement, it may cause consequences with membership. And we'll usually flag those issues for you. The governing board.
Stabler, on that point, I would really appreciate if you did, and you have in the past. That's one thing I would look at quite closely. I do not want to get out of compliance with the streamlined sales tax agreement. So if you kind of let me know, and as bills go through, and that will be a factor in our decision.
Mr. Chair, yes, I will do that. The governing board of the agreement does meet periodically throughout the year, and sometimes the agreement is amended, and that has all of member states' input, and it requires a vote and all sorts of, formalities. And that also may require the state to update statutes, and typically, the Department of Revenue puts those in their policy and technical bill when those come before the committee, and usually those are pretty technical and don't have a cost. But yes, they will require some legislative action at some point. For local sales taxes, in general, Mr. Williams indicated this when he was talking about income taxes, but there is a law that restricts localities from imposing local sales taxes and local income taxes. However, there are some other statutes that notwithstand this prohibition and do allow for some certain local sales taxes to be in place. General local sales taxes, lodging taxes, and county transportation taxes all have their own statutory framework in law. So when I use the term general local sales tax, it really just means that It's kind of what you think of when you hear that a city has a local sales tax or a county has a local sales tax. These taxes apply to all transactions within the jurisdiction that the state sales tax would apply to. So if the item being purchased is exempt at the state level, it would also be exempt from tax at the local level. These taxes fund specific capital projects with regional significance that are authorized by the legislature as well as the voters during a referendum. And typically, these taxes expire after a certain amount of time, or they raise a certain amount of money to complete the project. Statute requires that DOR collect these taxes and then remit the revenue back to the locality, and they do that quarterly throughout the year. Statute doesn't typically, or it doesn't at all cap these rates, and they're specified in each city or localities. Special law, 0.5% is most common, but some go all the way up to 1.5. In 2023, the legislature authorized the creation of a task force that kind of examined the implementation of these taxes. And in the meantime, there was a moratorium put in place on localities implementing these, and that moratorium expires June 1 of this year.
Representative Anderson?
Thank you. I know maybe last summer or at some point, there was talk in Minneapolis about implementing a Minneapolis income tax. And does that fall under where they would need legislative approval to do so? Thank you.
Hagler?
Mr. Chair and Representative Anderson, yes, they would need legislative approval for that. That would fall under the general prohibition.
Thank you.
Thank you, Representative Anderson. Just because you need it doesn't mean you get it.
Right.
Ms. Hagler?
Oh, looks like there's a question.
I'm sorry, Representative Johnson?
Thank you, Mr. Chair. Question I have is, I guess I went back to, because on this page 33, it talks about restrict certain legislative actions, state rate must apply to entire base. So instead of, I guess, how does that play into, they decide, well, we want to charge more for liquor, or we want to charge for a different product. So liquor has an extra layer of tax on it. Do they just call it something different, so they say they're staying within the statutes here as a true sales tax?
Ms. Hagler?
Mr. Chair and Representative, yes, so the liquor and cannabis both have what's called a gross receipts tax, so it is different from a standard sales tax, and the agreement does carve out exceptions for certain products that they can kind of go above and beyond the sales tax. So a gross receipts tax would acts like the sales tax and applies to only certain items, and is the whatever the rate is applied to the gross receipt from the sale. So it's taxed on top of sales tax and combines into one larger rate. So it is called something different, but in practice kind of acts like a sales tax.
Is there, thank you, Mr. Chair, is there, how many products is there, how many products is there that actually have this?
Ms. Hagler?
Mr. Chair and Representative Johnson, I believe it is only liquor and cannabis that have gross receipts taxes.
Okay,
Representative Johnson?
thank you.
Ms. Hagler?
Where is it? Okay. So county transportation taxes are also general sales tax in that they apply to an entire base. The counties don't need legislative approval for these because they are in statute, and the statute caps the rate at 0.5%. And the proceeds of these taxes are used by the county for their transit and transportation projects, and they generally don't sunset or expire. And they also don't require legislative approval. And then the last group of taxes are termed special local taxes in that they only apply to certain transactions and have narrower bases than general local sales taxes. Lodging taxes are authorized by statute and apply to a typical lodging like a hotel stay, et cetera. Voter approval isn't required for these, and they go to fund the locality's tourism promotion and are capped at a 3% rate. Food and beverage and admissions, entertainment, and amusement taxes all require legislative approval. These are much less common throughout the state, because they are imposed by special law only. And food and beverage taxes are then imposed on kind of what it sounds like, food and beverage transactions, usually including alcoholic beverages at places of refreshment like restaurants, cafes, and bars, those kinds of things. And these taxes usually fund a specific capital project, but may not sunset. And then just a little bit more about how the state and local sales tax rates kind of combine. Sales tax generally is destination-based, and thus the combined total tax rate of the jurisdiction where the sale is occurring or where the delivery occurs is the rate that will prevail on the transaction. So if you purchase an item here in St. Paul, you will have St. Paul sales tax plus Ramsey County sales taxes. But if you are buying something on your computer here in St. Paul for delivery in your home, somewhere like Minneapolis, then Minneapolis sales tax and Hennepin County sales tax will apply to the transaction.
Representative Robbins?
Thank you, Mr. Chair. Thank you. Nice to see you again. So the governor's come out with this additional sales tax proposal, and I'm sorry to see that no one from Department of Revenue is here, but I wondered, could you outline what professional services that sales tax will apply to and what the rate is?
Ms. Hagler?
Mr. Chair and Representative Robbins, I believe the exact language hasn't come out yet, just the recommendation. And from what I read from the release was that the state rate of 6.5% would be lowered to, I think it was 6.4025%. And then the sales tax base would then be expanded to cover professional services such as legal, accounting, banking, those types of services. Those were in his recommendations.
Representative Robbins?
Thank you. Yes, I read the same release, but we're still looking for details. It seemed not, do you think that's the entire list of professional services they plan to include, or have you learned any more about what exactly will be covered?
Ms. Hagler?
Mr. Chair and Representative Robbins, no, they haven't released the language, and without seeing the exact wording, I can't really say for sure.
Representative Robbins?
Thank you. Well, appreciate you keeping us updated. If you do see anything, and if the department is listening, we hope you will come and join us for a further discussion of this proposal. Thank you.
And thank you, Representative Robbins. I'm glad you brought that up. Just so the committee knows, I have offered the Department of Revenue to have and the governor also, a full hearing on his tax proposals, so we can get, very good questions you have. I'd like to know the answers to those too, and so hopefully we can get them in here as soon as possible, so we can ask those questions directly to the department who would have to administer things. So just so the committee knows, like I said, the offer's been made, full hearing, however many meetings they want. We will hear that bill, and these can get a little tricky. It doesn't mean that I personally support the bill, but I think as a courtesy, as tax chair, and as a tax committee, we need to hear the bill in its entirety, and I would like to do that as soon as possible. So Representative Swazinski.
Thank you, Mr. Chair. I've got a couple of questions. So
Sure.
my first would be directed towards you, Mr. Chair. So just we discussed a little bit about the governor's budget, a little bit in taxation and stuff. And would you characterize a tax decrease that brings in more money a tax decrease?
Well, his proposal has their increases.
Oh, okay,
Yeah.
because I had heard that maybe it was a decrease, but then it brought more money in. But I wasn't sure, I just wanted to wrap my head around.
We'll have to get some definitions there,
Okay, sounds
because
good.
in my simple world in section 28, Sumner Township, Fillmore County, we learned that if you have more money coming in, about 421 million, that would be an increase.
Okay, I just wanted to, because, when you look at, headlines and, I'm just trying to get that all figured out, but I appreciate your clarification, Mr. Chair. But my question runs along the lines of sale and use. And we talked a little bit about the sales tax on marijuana, but also liquor. And I know a lot of the discussions last session talked about the fear of raising taxes too much on marijuana would potentially lead to a higher cost of it. So the government marijuana wouldn't compete to the private sale of marijuana or black market sale or whatever you would call it. Has there been a calculation from a liquor standpoint, with taxation and a taxation on marijuana, to see, are they like taxes? Are we increasing the cost of liquor, inadvertently compared to how much we would increase the cost of marijuana by the taxes? Has any of that been kind of calculated as far as, like if I go buy a beer or I go buy a marijuana, like how close are those taxes per drink or smoke or whatever you'd call it? That's more of a general question that, if that could be calculated, I'd love to see it, to see, within a taxation within marijuana versus like liquor, how would those compare across impairment?
Ms. Hagler?
Mr. Chair and Representative Swedzinski, I don't know that that has been fully fleshed out and studied. I know that the gross receipts tax on liquor is 2.5%, and the gross receipts tax on cannabis and cannabis products is 10%. So the one is higher than the other, but when it comes to base price and, potency and all of that, how that equals out, I'm really not sure, but we'll look into it.
If there's something,
From Lyon?
Mr. Chair, thank you. If there would be something, that'd be interesting to see. Thank you.
And that's a very good question on the, now that marijuana is like legal, it's gonna get rid of the black market. There'll be nothing sold in the black market anymore because now we're gonna tax it. It's all gonna be coming in. How much is still going on the black market? Do we have anybody that can make an estimate on that? I don't need the answer today, but I think there's a lot of doobie being sold that's not being taxed. I would think.
Sure.
So,
The
Representative Joy.
Doobie Brothers, that's really good.
Great question. Last year I learned when we were going through the cannabis bill that you could buy a stamp, remember, to have. And so I'm wondering how many of the stamps, now that it's became legal, to make sure they don't have it in the black market being sold.
Thank you, Representative. I forgot all about that. I bought some of those stamps. I don't know what they do, but it was something about I could buy marijuana now legally or something. I framed them. Haven't used them. So I guess I'll talk to you offline on some of this, but I am kind of interested in how big is the black market versus the legal market? So, okay, other questions for Ms. Hagler? But she's saying, I hope not. Ms. Hagler, as always, wonderful job. Thank you. Okay, any questions for Ms. Hagler? Okay. And it kind of makes it tough here because we've got some questions that are very important on how we're gonna be moving forward on this. And we don't have any, over the years I've chaired any committee. At the end of a bill being testified, you got the people for it, the people with concerns. And then I always bring the department down or give them the opportunity to talk about a bill so we get it right. Now, not that they're always right, but at least we know where they stand. So hopefully this little charade that's going on will end quickly because we have a lot of work to do. This is serious stuff. We need to get on with it. Okay. Ms. Hagler, anything else? Okay.
Thank you.
Mr. Swanson, thank you, Ms. Hagler. Mr. Swanson.
Mr. Chair and members, I'm Jared Swanson, also with House Research. I primarily staff the areas of property taxes, state aids to local governments, and some of the minerals taxes. As Mr. Williams mentioned at the beginning of the presentation, this particular set of slides deals mainly with state taxes, and property taxes are primarily a local government tax. We'll get into a lot more detail about property taxes in general tomorrow, as well as some more information on state aids to local governments. I more or less wanted to use these two slides as an opportunity to introduce myself and just say we'll talk more about property taxes tomorrow.
Okay, any questions for Mr. Swanson? Representative Johnson?
Thank you, Mr. Chair. Yeah, I was just wondering, I know you're touching on what you had said before, so is it, I guess I'd just like to get the taxes committee's opinion also on that. Is tax cut in one area that raises tax in another area, is that still considered a tax cut?
That's a very good question, and the answer that I have received is, if you're putting a tax bill together, and in general, if the taxes go down, it's a tax cut. If they go up, it's a tax increase. But, who was I talking to? There can be an offset. So if you raise this tax, but you lower this tax by more, it's a tax cut. So you can have, in tax bills, you can have tax increases and still say the bill has tax cuts because you go with the totals.
So if you just, so if one area can say, Mr. Chair, we're gonna reduce our taxes, but another area is gonna raise your taxes by the same amount, just in another way, is it still considered a tax cut?
Well, I say if taxes are increased, it's a tax increase. If they're decreased, it's a tax decrease. And we'll have at some point here, our House Fiscal that will be very important to us on those questions.
So, thank you, I just bring that.
Johnson. Okay. Was that Mr. Swanson? But you're not quite done yet. Because the committee chair has not made a decision yet on how we're going to handle the myriad of property tax bills that will be coming forward. In the past, we've had, the Senate generally doesn't, but in the House, we've had a property tax division. And like I'd be chair of the tax committee, and then Steve Drazkowski or Representative Runbeck or somebody would take the property tax. There'd be a lot of bills. They put in a lot of meetings, a lot of time, you know that. So I would like to talk to you offline, and members, this goes to all members here too, and staff. What's the best way to handle that? Because if we think we're gonna hear every property tax bill coming through this place, we're gonna be having some long nights. And nothing wrong with long nights, so I need members' input. I do want House research input on maybe how we can handle that within. We are the tax committee. We will handle all the taxes we're talking about, plus property taxes. But I want to be somewhat efficient on that, so I don't know if we set up a working group. And this will be my decision, but, you know, a working group, maybe 4 or 5 members, look at all the property tax bills, bring us to things that you think are good. So that's another conversation we'll be having. I just want you to know that decision has not been made, but we're gonna have to make some decisions on that. Okay, yes, Representative Anderson.
Mr. Chair, is it, I don't want to say too late, but to set up a property tax division committee?
No.
I can go to leadership, and we're the legislature, we can do whatever we want. Might be a good idea. I will have that discussion with leader, the speaker and the majority leader on just some ideas on that. Because I'm not sure how this is gonna work if this committee hears every property tax bill. It's gonna be like, you know, a John Deere bee trying to pull a 13 bottom plow. It just doesn't go too good. Representative Swazinski.
Mr. Chair, just, you know, I know oftentimes, sometimes a committee will set up a working group too. So like if you got specific areas that maybe want to have a little bit of a deeper look, just to kind of take generalizations on things, to take a look at it, you know, rather than create a whole new committee. But, you know, you could create a working group, a bipartisan one, of course, and go from there.
Thank you. And in the past, the property tax committee, it wasn't a requirement that you are on tax committee. Because we've had, I don't think it was, you'd have members that were not on tax committee, that were on property tax committee, have a big interest in that. So that's a discussion that we'll be having soon with leadership, just to see what direction they want us to go. Working group might be a good idea. Every tax bill will defer to the working group, and then come back with a report. So, okay, so that has not been determined at this point. Okay, we are now with Ms. Hagler.
Mr. Chair and members, I'm just going to briefly touch on some other state taxes that make up a smaller percentage of the state's revenue. They're listed on the next 3 slides, and just kind of wanted to make you aware that they exist and generate income for the state. So there is the estate tax, the taconite production tax, occupation tax, and gross proceeds tax. Some others are the tax on cigarettes and small cigars, tobacco products, cannabis and alcoholic beverages, which we've kind of touched on, and then tax on lawful gambling. Just wanted to note that the, underneath the lawful gambling section, the rates listed here are not correct. I forgot to update them. They are correct in the actual booklet that we handed out. And then lastly, the mortgage registry tax, the deed-transfer tax, min-care taxes, and the insurance premiums tax.
Okay, questions on that, Representative Anderson?
Thank you, Mr. Chair. Do we have information, the federal estate tax exclusion is 10 million, and do we have information on the cost, I guess, the difference between what we have as a 3 million and the federal? How much is actually gained in income because of the difference there?
Mr. Lehman?
Thanks.
Mr. Chair and Representative Anderson, I think you're talking about, say, a dynamic effect on estate taxes, where I think sometimes a concern arises that, well, if the taxpayers might actually switch their residency to avoid state estate tax, and does that have a dynamic effect on the amount of, so they would change their residency, that could have a knock-on effect on the income taxes. That's typically, as far as like any official documents that we would have, that's typically not something that Department of Revenue Research would estimate. I know there's been some analysis in the past on that from like the National Bureau of Economic Research, but I don't have that with me today, but I could certainly send you a copy of that paper if you're interested.
Representative Anderson?
Thank you. Yeah.
Okay. To Ms. Hagler, estate tax based on a state's value, $3 million exclusion, it's still the law though for agriculture or farms if they stay in the family, or businesses if they stay in the family is 5 million?
For small businesses.
Mr. Lehman?
Mr. Chair, yes, so in addition to this is an estate tax. So in addition to the $3 million exclusion, under the estate tax, there's an additional exclusion for qualified farm and small business property, and that allows estates that have that property included to potentially have a $5 million exclusion.
Okay, so that's still in place.
Correct, Mr. Chair.
Okay, any other questions? Representative Johnson?
Thank you, Mr. Chair, thank you for asking that question, because I was going to inquire about that. So the 3 can go up to 5 with farms, is what you're saying, correct?
Mr. Chair and Representative Johnson, correct.
Okay, so a total of 5.
Representative Johnson, that is under certain conditions.
Yeah.
Can I hear what some of the certain conditions are?
Mr. Clayman?
Sure, Mr. Chair and Representative Johnson, so to qualify for the additional $2 million potential exclusion, that's limited to certain types of property, and those are defined by statute. And so there are other requirements that have to be met under statute for that to become qualifying property. And then there are certain clawback mechanisms too that would apply to the property. So you have to hold on to it for a certain number of years and so forth.
Thank you. Mr. Chair, can I get that sent to me? Or where can I find that? I'd like to learn more about those.
Yeah, Mr. Chair, Representative Johnson, sure, I can send you some information on that. I'll have to dig through. The Department of Revenue came up with a report a number of years ago on the qualified farm and business property subtraction, so that might be a good place to start. But
okay.
I'll follow up.
Thank you.
Johnson.
Thank you.
Okay, other questions at this point? Okay, let's continue. Mr. Williams?
Chair Davidson and members, we put together a couple of slides just sort of more broadly about the Minnesota tax system. We thought it might be helpful for members. So Minnesota is often characterized as a high tax state, and we wanted to give a little bit more color and detail sort of on how we shake out relative to other states. So at the top of this slide, you can see our total taxes as a share of personal income. We rank about 8th in the country. If you expand that to include state and local taxes, our state is 12th in the country. And if you also include local taxes and fees, we are 19th in the country as taxes as a share of personal income. Our tax system is considered to have low regressivity or very progressive. So there was an analysis that ranked us 50th out of 50 states in tax code progressivity. Our corporate top marginal tax rate is the highest in the country, so we're first in that one. For the individual income tax, the amount of tax, sort of where our tax ranks, sort of depends on how you measure it. So there's an analysis by a local organization that showed that the tax paid by a filer making $1 million for tax year 2018 would have been fourth highest in the country. Our top marginal rate is seventh highest in the country, but the tax paid by someone making $50,000 would put us 30th in the country. And the property tax, it's sort of, we have examples here for a $1 million commercial property in the largest city in the state. So that would rank 13th out of the 53 cities analyzed, one for most states and two for a couple across the country. On a median value home in the largest city, we would rank 24th.
24th?
24th, yes, that's correct. In terms of sales tax, our combined average local, state and local sales tax rate ranks 15th in the country, but we have a relatively narrow base. So our base breadth is ranked 35th in the country. So that gives you some sort of color on sort of how our tax system fits in relative to the rest of the country.
Representative Robbins?
Thank you, Mr. Chair. Thank you for this. It's very helpful. But I think it would be more helpful if you could give us this with the numbers rather than the circles.
Sure.
And then secondly, the only one that's indicating a tax year is the income tax. So could you provide it with the indicated tax year this data is from? Because 2018, I mean, there's been a lot of water under the bridge since then, so I'd like to get it updated.
Mr. Williams?
Chair Davids and Representative Robbins happened. The next slide on the presentation does have some of the dates, so you can get some more detail there. I called out that 2018 one because, as you noted, it's a little bit outdated. That's from the Center on Fiscal Excellence locally compiled that analysis, and I communicated with them, and I think they have a newer one coming out soon. But I think that sort of the policy changes that have been enacted since then are likely to sort of push down the income tax rate paid by someone making $50,000, push up the income tax rate paid by someone making $1 million. So as you said, there definitely have been policy changes, but I sort of wanted to include that to sort of get a picture of how our income tax looks compared to other states. But happy to send this out with the specific details if that would be helpful as well.
Representative Robbins?
Thank you.
Representative Wiener?
Mr. Chair, in your opinion, I would like to know, the corporate top marginal income tax, we're number one. Would you consider that corporates or corporations paying their fair share?
I'm going to have to do some more analysis on that to determine that issue.
Thank you, Mr. Chair.
Please don't use that in this committee. I'm sorry. You can use whatever you want. The gentleman from Lyon.
Thank you, Mr. Chair. And just to Representative Wiener's question, I think the tax incidence studies talk about corporate taxation, and corporations aren't probably necessarily actually taxpayers, but they're tax collectors. And so, we say, your fair share, but ultimately, I think they say from a Minnesota standpoint, Minnesotans, if we have a corporate tax, pay approximately 45 to 46% of that tax, and then it's left at that. Well, if you continue that question, then it would be, well, people outside of the state then also pay a percentage of that tax, so another 40% on top of that. So 80 to 90% of corporate tax actually get passed on to the consumer. So when we're saying fair share, corporations don't necessarily pay taxes, they collect taxes from their customers. And so when we're talking about the basic lines of competition, if those taxes are being passed on as a cost, then, the cost of doing goods and selling services for Minnesota companies is gonna be more expensive. And so when we talk about fair share, I know it was in jest, Representative Wiener, but I thought I would just make that point, just so it's on the record for the people of Minnesota as you're listening, because there is important work to do here, and I'm just thankful that we're here and doing it. So, thank you.
Because I would say, Representative Wiener, about 3 weeks ago, maybe, I sent in my estimates, and I just really felt like I was paying more than my fair share, whatever that number is. And I did notice that after I sent the checks and the state budget collections went up. So if you notice the correlation there. Okay. Ms. Hagler or Mr. Williams?
So Chair Davids, I flipped through the slide that had the sources for that chart, but just want to make sure that they were included to sort of see where that came from. On the next
Thank you,
chart.
and what you did there, I think was very interesting, very helpful. And I wrote down 1st, 4th, 30th, I wrote those down. I'm gonna keep this because that's, Representative Wiener's comments, I think we're all paying more than, well, we're not all paying more than fair share, the certain percentile, if you look at the suits index, there are those of us paying their fair share, whatever that is. Mr. Williams.
Chair Davids and members, speaking of the suits index, so one way that we measure state taxes is progressivity, and that's sort of how the income, the share of tax paid increases as the sort of, as you move across the distribution of people by income. So the suits index is one way of measuring that. Suits index ranks tax on a scale of -1 to 1 and from regressive to progressive. This shows all of the Minnesota state income taxes, or the state taxes. The two progressive taxes in our state tax system are the estate tax and the individual income tax. All of the other taxes are regressive and considered regressive by our state, by our tax system, which sort of speaks to the point that Representative Swedzinski made. I'm gonna talk pretty quickly. This is just sort of different values that people use to sort of talk about when evaluating tax proposals and evaluating a tax system. These values often trade off with one another, and I think you as members and as a committee will disagree on the sort of relative importance you might place on different values. I think this might be useful to think of as a kind of a toolbox for thinking about proposals through the committee. So one way to think about proposals is equity. There's horizontal equity. Do two people making the same amount but maybe having different kinds of income or different situations pay the same amount, have the same, with the same ability to pay the tax, do they end up paying the same amount? Vertical equity is just do taxpayers with a greater ability to pay more tax. So that's sort of the measure of progressivity we just talked about. Economic efficiency, so taxes typically introduce economic distortion. Taxing something causes people to do less of it, and so that might be, you know, introducing a tax may reduce economic efficiency and cause economic distortion. Simplicity, transparency, and administrability, so the more tax expenditures or more detail and complexity we build into the system, it reduces those things. I mentioned here that economic distortion and compliance costs due to tax code complexity are considered deadweight losses. They don't make anyone better off. Competitiveness, does our tax system disadvantage the state, competing for investment in business relative to other states? Revenue sufficiency, does the tax system raise enough revenue to fund state government? Certainty, can taxpayers adequately predict what they will pay in future tax based on their situation? And then I mentioned earlier the compliance and tax gap, so maybe a very complicated or difficult to administer tax may may have a high tax gap. It's very difficult to collect. I'd note that when you see property tax proposals, they get scored on 6 benchmarks, which are very similar to these. Tax incidence. Tax incidence is a way of describing how the burden of tax falls across the distribution. So as I mentioned, taxes can be proportional, regressive, or progressive. And also the effective tax rate is a way of measuring it. That's the amount of tax paid by a group or individual divided by that person's income. I just note that the Department of Revenue completes a tax incidence study every 2 years. So the data I presented for the state taxes comes from that study by the Department of Revenue, and sometimes the committee hears it. Like I said, it shows most taxes in Minnesota are regressive, meaning lower income taxpayers pay a higher share of their income and their total income in tax. And the state and individual income tax are the only progressive taxes as and analyzed by that study.
Representative Robbins.
Thank you, Mr. Chair. Oh, Mr. Williams, I had a quick question for you. I thought it was curious that the property tax revenue estimates are scoring bills based on those 6 benchmarks. Why are those 6 benchmarks not applied to the other areas of taxation?
Mr. Williams.
Chair Davids and Representative Robbins, it's just a requirement in state law that when they produce those estimates, they be scored on them. And it just only applies to the property tax ones.
Representative Robbins.
Thank you. So we could request it even though it's not required in statute.
Mr. Williams.
Chair Davids and Representative Robbins, yeah, you could request that from the Department of Revenue, or you could alternatively introduce legislation to sort of require that as well.
Great,
Not
thank you.
sure how we do that, requesting from the department. They're not here. Representative Robbins.
Thank you.
Okay, any other, Mr. Klain?
Mr. Chair and members, yeah, if you're ready to move on, I'll handle the next 4 slides.
I think we're ready.
Mr. Chair, this is somewhat new to this presentation, but we thought it would be good to just do a brief overview of constitutional issues that can come up in taxation. So throughout the course of a legislative session, you may see some state laws that are subject to some sort of constitutional controversy, or that may arise in a bill that's moving its way through the legislature. There are three main areas where this comes up. They're listed on the slide. The number one issue is usually the Commerce Clause, specifically the dormant Commerce Clause. That's the one that's come up in taxes fairly frequently. For the most part, nonpartisan staff will flag these issues. There may be other stakeholders that will flag these issues as well. I just point out that, unlike other aspects of the law, typically when it comes to, trying to figure out the effect of a constitutional issue on legislation as far as, is it going to be litigated? What's the effect of that litigation, et cetera? It's more of an art than a science because there can be changes in jurisprudence and other factors in a particular bill where maybe the facts are different than another piece of legislation that's been litigated in the past. So typically this is a little bit more vague of an analysis. I'd also point out that if somebody points out a constitutional issue with the bill, it doesn't mean the bill is dead. It doesn't mean that you have to pull it. Typically, it just means that you may, if you want to, think through some of the trade-offs that might occur to mitigate that, or there may be a change in drafting that we'll recommend on that as well. On the other hand, too, I would just point out that often state legislatures do intentionally pass bills that they know violate a certain constitutional precedent. I think most notably in the tax area on the Wayfair case. So, and that was a nexus issue, again, under the Commerce Clause. I won't spend too much more time on these slides, but the biggest issue in Commerce Clause is discrimination. So this prevents states from acting in economically protectionistic ways primarily. Also prevents state legislation from imposing an undue burden on state taxation. And so typically that's usually where the bigger issues arise. But again, nexus issues can be common. That's what happened in the sales tax area in the Wayfair case that I mentioned earlier. And then lastly, there are a couple other provisions that sometimes come up in this area under the Privileges and Immunities Clause and the Equal Protection Clause. And as those issues arise, we'll flag those for you. And some of those have to do with the state constitution as well. Direct spending programs, not in the tax code. Typically, legislatures have more flexibility with the Constitution in doing those.
Hey, Mr. Clayman, any questions for Mr. Clayman? Okay, members, what we're going to do here is, with Ms. Templin and Ms. Highmark, we're going to stop here for there to be a few announcements because I don't want to get you up there in the middle, train of your thought, we cut you off. I don't want to do that. You have some very important stuff to share with the committee, some very important information, and so we will pick that up tomorrow. Members, the next meeting is Wednesday, January 22nd, 2025, 10:15, same spot, same place right here. I am in a bit of a situation I've never been in that as chair, being the Commerce Chair back in 1999, I have always heard DFL bills first, always. We're going to break that tradition because it's really it's a genuine conundrum, a quandary, if you will, a real life dilemma because they're not here. So I don't have any DFL bills yet. So it's kind of hard to hear them when they're not here. So, like I said, we've got a lot of very important work to do, and we do need to get on with it, and hopefully those seats will be filled very shortly. So again, the next meeting, and thank you, Ms. Temple and Ms. Highmark, I don't want to just go 5 minutes and then say we're done. So with that, anything else for the good of the order? Okay, with that, good government all the time, we are adjourned.